Hello, everyone. Thank you very much for joining today's webinar, which I'm going to spend the next 30 minutes or so talking about ways in which we can reduce the tax that we have either paid or are going to pay this year. For those of you that don't know me, my name is Nick Sean-Ambus, and I'm the Managing Director of Alpha Wealth. I'm joined by two of my colleagues today, Ruth Murray, who's head of our marketing department, and Clean O'Donoghue, who is Director of our business development. Just while we're waiting for the numbers to settle, my colleague Clean is just going to put up a poll. We're just trying to gauge a little bit in relation to how much tax people typically will have suffered this year. And it might just help in relation to areas in which we can kind of give you some guidance. Please feel free to put any questions that you might have into the Q&A. We try to make these sessions as interactive as possible. And I've got a lot to cover, so I'm going to go through it relatively quickly. But I would encourage you to please feel free to pose any questions that you have into the Q&A, and it will be looked at. We have received some questions over the last few weeks, which I think Clean is going to address. Just very briefly to start with, Alpha Wealth are a progressive financial services company. We've been in business for over 10 years now. We have an office in Cork and a small presence in Dublin, and we're very progressive in what we do. We deal with all types of employees, self-employed, company owners, giving advice across a whole range of different types of financial products, and we have a lot of joint experience between us. So the main focus today really is on tax. Tax is the biggest expense that we face during our lifetimes. And if you take an example of, say, a couple earning roughly 150,000 euros a year gross, they pay over a third of that income in tax, which obviously over a period of, say, even 5 years accumulates to over €250,000. The other issue is that if they try and use the money that they have to grow their wealth, they pay further tax on that. And then if they try and leave that money to children or other individuals, there's a further tax taken. It seems very unfair, but there are ways in which I think we can easily mitigate that. And I'm going to run through 4 main ones with you. I'm going to talk around pensions. And I know some people may get turned off by the word pension, and it becomes very, very, I suppose, in the news, particularly this time of year, because of the fact that we have an opportunity until the end of October to make a return to reduce the tax that we suffered last year. And I'm going to touch on that as I go through this. There's an investment scheme which is backed by the government called the Employment Investment Incentive Scheme. And it's an opportunity for high rate taxpayers to get tax back this year over a 4 to 5 year qualifying period. Taking advantage of gift allowances that mitigates the tax that our children and possibly grandchildren will pay is another area which I think is vastly underutilized. Any parents that are on the call today, I would encourage you to pay attention to that part. And my colleague David Looney is running a webinar next week, which I'm going to provide some details of, where we're going to drill down a little bit more into it. And then the fourth area is claiming expenses. It's still something that many of us fail to do, and yet there's so much money available really easily for us through using a very simple tool, which is the Revenue Online system.
And Nick, with the budget coming up on the 1st of October, can you give us an idea of how it may impact any of these 4 points?
Yeah, it's a really good point. There's going to be a few areas that will be impacted. One of them is on pensions, which I'll touch on in a second. As well as that, the government are looking to increase the gift allowance that we're allowed to pass on to our children or inheritance, which is a positive. It hasn't been touched for the last 10 years. It looks like anyone who's listened to the call live today on the 12th of September, the ECB are going to reduce interest rates by 0.25% today. The inflation number came lower than was expected, so it seems fairly certain. And it looks like there may be another decrease before the year end, which is positive, obviously, for any mortgage holders out there, particularly those on a variable or a tracker rate. I'll touch on the budget later on, but again, just in terms of pensions, when I spoke last week on Ireland AM about the fear that over 50% of people have about this reduction in their income when they retire, one of the main messages that I try to leave is that you should think about your finances and segregate them into 3 different aspects: the short, medium, and long term. And talking about long term, which is typically kind of from 55 to 60 onwards, which is approximately a third of most of our lives. Most of us are living now until sometime in our 80s. The key thing really is that you can save into a savings plan. That is a pension. It's dressed up and it's made more complicated by my industry. But by doing that, whether it's a contribution of 10 euros a month or 100 a month or 1,000 a month, and the Irish government will give you back a really effective return of either 20% if you're earning less than 42,000 a year, or 40% if you're earning over 42,000 a year. Now, bearing in mind that the average income in Ireland is about 44,000, most of us can probably apply, and bearing in mind that this includes any bonuses that we may have received, tax relief at 40% on all of our contributions. So for anyone that puts in a contribution before the end of October, which allows you to go back to 2023 income, you will get 40% back on that contribution. And you're going to hear this advertised in the press, on social media, and through the news that self-employed people, PAYE individuals, or directors, so basically everybody that's listened to this call, has an opportunity to get tax back for last year if they make a contribution into this savings fund, as I've described, before the end of October. And if anyone is in a position to look at doing that, please feel free to reach out to us. As impartial advisors, we can give you guidance about making the most of this opportunity. And by the way,
when can somebody withdraw from their fund, from their pension fund, for other investment or expenses?
One of the areas that we focus on with clients is that we don't have to wait to the normal state pension age of 66 to draw a pension scheme. Most of us will qualify for the state pension, which is worth about 250,000 euros, believe it or not. It's equivalent of 14,000 a year, payable from the age of 66. But to answer the question, we can access pensions typically from the age of 60. If it's a company pension, from the age of 50. If we've worked for a company in the past and we had a pension scheme with that company, we can access it at any time. And I talk about the fact that a lot of us have this desire to consolidate our pensions. I really don't think that's a good idea. And again, this is one of the areas that we advise our clients on and can help any individuals listening to this call, that we can help you understand where are your pension schemes in different places, whether it's in the UK, in Ireland. I've worked in the UK previously, and for anyone that has worked in the UK for 3 years or more, they should be taking advantage of an opportunity to buy back UK state pension years. It's a really big opportunity. And again, if anyone is listening to this call that has worked in the UK, please do feel free to reach out to me. I can give you some very, very simple advice as to how to go about that. But to answer the point, typically from age 50 onwards, a lot of us have the ability to draw pension funds and take what we call this phased approach to retirement. So rather than stopping on any given day, that you can start to either work less hours or change careers, not do the overtime, and be in a position of what we call financial independence. And again, following on from that, I'm doing a webinar on the 3rd of October, which I'm going to give some details of later on, around this whole notion of what does financial independence look like for you? When do you think you can achieve it? What does it actually require you to do? And how can you do it in the best manner possible? Just on pensions, and again, I just want you to think of pensions as a long-term savings plan. We've got enormous capacity, even as employees. Company owners have an even greater capacity to put money into their pension schemes. But as employees, depending on your age, and again, those of you that can see the table on the screen, you have the ability, if you're say in your 30s, to put 20% of your earnings into a pension. So say, for example, last year you earned 50,000 euros and you might have contributed, say, 2,000 euros into your pension scheme. Revenue will allow you to make that shortfall, 8,000 in this example, 20% of 50 is obviously 10, less what you've already paid. And you will get 40% back from the government by making that contribution within a couple of weeks of making that payment. The money will grow tax-free and you can access it from 50 years of age. It really is a good way of reducing the tax that you pay. One of the things that I'm going to touch on now is how can you reach financial independence? And again, this is really in advance of the webinar I'm running on the 3rd of October. let's say you were in your 20s, and people often ask me, Nick, what stage should I start a pension at? And I say, well, from the earliest position that you can be. If you're in your 20s, you should start. If you're in your 30s and so on, it's never too late. And this example is showing for somebody who has a company pension scheme where the company is matching their contribution and assuming that they're on an income in the higher tax band, they will be able to achieve financial independence at the age of 50 by making what is a relatively moderate contribution to their pension. Now, again, I'm not going to get into too much detail today, but just to give you a sense of the fact that I think we're all probably in a better position in the future as long as we can start making some provisions now. I want to just talk about the medium and term, which is really that sort of 3 years from now to that age of independence, whether it's 55, 60 or 65 years of age. And the key thing is that you've got to look at where your money is and making sure that it's actually working for you. We talk to clients around regular savings plans for either their children for the future, for whether they want to try and acquire a property in the next few years, whether they want to aspire to buy an investment property, or indeed build up a fund to buy cars every 3 to 5 years and so on. And the biggest mistake a lot of our clients make is that they leave these monies in low interest accounts in the likes of the credit union, post office, and so on. And really, for us, the reason why we set up the Alpha Savings Club is to show people that there is an opportunity for you to invest monies or save regularly, where you can get access to your money at all times without penalty. You can get access to a broad range of different types of funds, again, under our guidance, where you can earn returns typically in the region of 5-6% plus. A lot of people we talk to are starting to look at investing themselves. This notion of ETFs, which are called exchange traded funds. A lot of videos I've seen, a lot of people I've been talking to recently, particularly in some of the tech companies, have been investing through the likes of DeGiro and other online platforms. And I'm slightly weary of the fact that whilst I'm not taking away the fact that people may want to invest their own monies, I talk about this core and satellite approach. And what I mean by that is that your core investment strategy should be your pension, your assets like property, investing in a broad diversified fund, whereas your satellite are things like ETFs. So if you want to expose yourself to cryptocurrencies, that can't be a long-term investment strategy for you.
And what about people, sorry, just to jump in, for people who accumulate shares in their companies, what's the best advice that you can give to people on this front?
Sell them. And again, I know it may sort of sound strange, and people might question why I would say that, but the biggest problem people have that accumulate shares in their companies, and we are surrounded here in Little Island in Cork by many multinationals, of people that are benefiting hugely from the shares that they accumulate and the growth that they've experienced in them. I've done a lot of calls recently with people working in some tech companies like Google, some of the pharma companies like Lilly, and their share prices have risen hugely over the last couple of years. However, the reason why I say sell is that you're going to receive more and more shares throughout your working lives, and you can't sell all of them. So it's only the vested shares that are available to you. And if you don't sell, you're going to end up with too many shares. They're not going to be diversified. You're going to carry more risk than you actually realize. You're not taking advantage of an annual gift allowance that you can sell up to 1,270 euros of a gain without paying tax. And you need to think about the opportunity cost of what you could do with that money, such as put more into your pension, where the money grows more tax efficiently. And as I said earlier, you can access it from an early age than you probably realized. And that to me is a much better financial way of you utilizing the opportunity that presents, in addition to paying down things like your mortgage, in addition to investing in other schemes that will provide you with tax relief.
And Nick, before you move on, and you've mentioned pensions, why should somebody not consolidate their pension?
Because not only are you restricting yourself in terms of the fund manager that is managing your pension scheme, it's probably better to have more than one. But the main reason is that, as I said earlier, you can draw these pensions at different stages. I have 3 pension schemes, and my intention is to draw them down from the age of 55 onwards that allows me the ability to restrict or reduce my working time and benefit from the tax efficiencies of getting that income that I need, but not in one lump, that I can stagger it out over several years. The key
Another
thing
two
for
questions
everyone,
before you move on, if you don't mind, just on pensions. Do you need to notify revenue of any AVCs taken through payroll?
no, you don't. AVCs through payroll. AVCs, by the way, are additional voluntary contributions. All of us should be considering whether we should pay into these schemes, whether it's through our current employer or externally. We deal with a lot of public service people that think that they're restricted to, say, Corn Market, who are kind of almost like a tied agent, and they don't provide enough diversity for people. But the key thing is to get advice, to get a roadmap, which we set out for all of the individuals that we meet, and understand what your number looks like. And what I mean by that is the number that will allow you to take that kind of phased approach to either retirement or indeed semi-retirement.
And is there any opportunity in Ireland to use accumulated personal pension fund like a PRSA for property investment under owner direction?
There is. That's getting into a little bit more detail for today. But if that person or anyone would like some advice around how can you use your pension fund to buy assets like property, it's something that we've done for many people. I've done it myself on an individual basis. If you're working for a company that has a company pension scheme, that's not possible. But from any previous pension arrangements you may have had, or if you are a company owner, you have the ability to make a pension contribution or use a previous pension fund to buy an asset like a property. The other thing for any company owners that are listening to this before the budget, there is an ability for business owners like myself that can make large lump sum contributions from your company without any restriction whatsoever. And I would say to you all, consider doing this before the budget, because it looks like the government may restrict that ability to make that lumpy payment. I just want to move on to the second of those four areas I was going to talk on today. It's called the Employment Investment Incentive Scheme. And I just want to mention one opportunity to explain how the scheme works. There's about 50 companies or so each year that look to raise money to grow. And by doing so, the government give any people that lend money or invest in those companies under a share arrangement the ability to get back typically 35% of their investment contribution. On the screen there, you can see a company called 5 Mile Concepts. It's a company that's based in Cork, just outside Middleton. It allows you an opportunity to invest in a bar, restaurant, and roastery. 5 Mile Concepts is a coffee brand that's been sold across all of Ireland, which in itself is a very lucrative income stream. And I often get challenged by people saying, why would we invest in a hospitality investment? A lot of these restaurants and bars are closing. And respectfully, a lot of these ones that are closing is because the fact is that they use the debt warehousing arrangements, and they were basically told not to reopen because they were never going to make money again. Lots of these businesses are doing well in certain areas, and we feel very strongly that this presents a really good opportunity for people. And I'm just going to play a very short video for you.
Do you want to get €3,500 back in tax this year? 5 Mile Concepts presents an opportunity you don't want to miss. Now, through the Employment Investment Incentive Scheme, you can be part of this growth. This qualifies for tax relief of 35%, which is the best option for a trading company. And so for a €10,000 investment, you get €3,500 back within 9 months. Imagine being part of this new venture, a state-of-the-art roastery and restaurant called The Fork and Wheel, based in Middleton, Cork. This space isn't just a restaurant, it's a hub for barista training and a dedicated coffee lab for the renowned 5 Mile Coffee. This is your chance to get 35% back in tax. Be part of a brand that's already a favourite in hotels nationwide. Don't wait. Contact us today
If
at
anyone's
Alpha
interested in
Wealth.
getting more information on that, we can provide it to you. The main reason for explaining it is that it's trying to put something visual that it suggests to you, and there's many companies out there in that space, many of which I wouldn't be in any way interested in. One of the main reasons why we like 5 Mile is that it's run by a company called Clistra, who own a number of hotels and restaurants up and down the country, including a number of Radissons, both in Cork, Dublin, and in Galway. And we feel strongly that it's really important to understand the opportunity that's out there for anyone that's paying tax at the higher rate. The third area I wanted to touch on was gift and inheritance tax. And this is a really important area for any parents, particularly that are listening to this. And as I mentioned, I'm going to mention a webinar that my colleague David Looney is doing next week. But the key point really to understand is that whilst many of us are not thinking about passing on gifts or inheritance to our children at this point, if you think about it, if you're putting money away, say the child allowance, into a savings account in your name, you're potentially building up a fund that may be used by them to buy their first house or to help them buying a car, paying for their wedding, paying for college even. And the biggest issue we have really is that the government will only allow us to give up to 6,000 if we're in a couple, or 3,000 from one parent to a child, without reducing their lifetime limit of 335,000 euros. Now, whilst I mentioned that the government are looking to increase this for the first time to 400,000 in the budget, it's still quite penal. If you think about the fact that over the last period since this was increased in the last 7 years, property prices have gone up 70%. This threshold has only been increased, it looks, by 25%, from 335 to 400. Now, if you leave a property to your child, let's say your own private dwelling, it's probably going to be worth more than 400,000. So if you only have one child, you're going to leave them a tax problem. If you have two children and your property is worth over 800,000, same problem. However, if you want to leave that one asset to one particular child, you're back to the same problem, regardless of whether or not you have other funds and so on. So really the point we're trying to make here is that there is an opportunity to get a bit of advice. And by the way, if that gift is being passed to anybody other than a child, those limits reduce drastically. For any other family members, it reduces to 10% of that figure. And then for strangers or anyone else for that matter, it then reduces by 20%. Just in terms of moving forward, and as I mentioned, my colleague David is going to talk about this in the webinar he's doing next week. But we have created this Alpha Child Savings Plan, which takes advantage of utilizing that annual gift, allowing that money to grow tax efficiently, and it doesn't fall foul of those penal limits that the government have placed on any gifts or inheritance that we try and place. I just want to touch on deposits now. And you might say, well, Nick, how is this a way of reducing tax? It's interesting. We've started to see the advent of banks such as Revolut, Trade Republic, Raisin, Lightyear, Bunk. And I'm trying to encourage people to start looking at these institutions rather than the traditional credit union, post office, and banks, because they do provide much better rates and a lot more convenience. Trade Republic, for example, which is the bank that I use, is a regulated institution that provides a 3.75% current gross rate to me, subject to dirt tax with no fees. So I'm getting 2.51% net, up to a maximum of 50,000 euros that allow me as an individual. And it's so easy to use, such as the same as Revolut. I'd use it on my phone with 24 hours notice that I have to give if I want those funds. Revolut, who is really creative in the way that they've advertised their rates, are advertising much higher rates for these what they call flexible cash funds. The biggest problem I have with them is that firstly, they require you to exchange currency. They offer those rates in dollars or sterling. And the other issue I have with them is that the tax rate is actually 41%, not 33%, and they don't really advertise that very well. If you're looking to get access to their higher interest accounts, which are not sterling or US denominated, then you have to pay Revolut 55 euros a month to get the 3.49%. It doesn't make any sense, basically. I wouldn't save with Revolut. I use Revolut just to send money to my kids when they need money for it. That's really the only purpose that I would suggest. There are other banks, Raisin I mentioned, that provide much better returns than the traditional banks, where you can fix monies on the screen there. You can see rates advertised of 3.6%, for example, with the Latvian A-rated institution. Now, maybe some people haven't heard of Blue Or Bank, the reality is that they're a much more secure bank than even AIB or Bank of Ireland. The rating that's provided to them gives some evidence of that. If you look at the bottom of the screen, there's a Swedish AAA rated bank, which is the same as the US government reserve in terms of security, basically the safest bank in the world. And that's offering a 3.4% gross rate over 12 months. Again, I would encourage anybody that has money that they want to leave on deposit for that short term, less than 3-year period, to look at these types of institutions. Final thing, claiming taxes on expenses. Michael McGrath said in the budget last October that many of us are still leaving money behind when it comes to claiming for things like the rent relief scheme that was introduced a year or so back, where we can claim up to 750 euros of rent. For anyone that's rented over the last 2 years, it's 1,500 euros. And if you're in a couple, that's potentially up to 3,000 euros. But yet still over 50% of eligible people have not claimed for this relief, which is absolutely madness. Going on to the Revenue Online system, that's really easy to use and navigate. You can also claim for the working from home relief, which applies for anyone that's been working from home during the COVID years and indeed continues to do so. You can claim up to 30% of any light, heating, energy, phone bills, and it's hundreds and if not thousands of euros that we're leaving behind just because we're not familiar with using the system. And I'm often asked, why do people not go on to Revenue Online? Maybe it's because they don't realize how easy it is, or maybe it's just they're just worried of bringing the taxman upon them. I've been in Ireland for 27 years, guys, and I've utilized this every year since. Although I have an accountant, I use Revenue Online because it's really, really easy for me to use and I can do it myself from behind my desk. Anyone making that ABC contribution into their pension scheme can make the claim themselves the same day that they get the cert back from that provider and get their tax back within 2 weeks. The reason why I think some people don't do it is that they think that they may have a tax problem. I can assure you, of those 27 years that I refer to, I've got money back in 26 of them. And the only year where I owed revenue money, it was about €5. So I would say to you that it is always typically favored in revenue's favor than it is yourselves. And I would encourage you to take advantage of that opportunity. So easy.
Do you know, do you know if you can claim the working from home if you get a remote working allowance from your employer?
That's a good question. I think the answer is no, but I can get it clarified. I think it depends on which is the higher relief that you can sort. It's 30% that you can claim on the various expenses. And I think there's a daily allowance of €3 something if you're claiming through. But that's a really good question. And if that person would like to reach out to me directly, I can answer it directly for them. Couple of quick things. We're doing a budget webinar on the 1st of October, which is obviously budget day at 2:30, and anyone can register for it. Go onto our website. These are just some of the things that have been noted. I've mentioned in terms of increasing that child gift or inheritance tax to 400,000. The usual things like increasing the threshold before we pay tax at the higher rate. It looks like that's going to be increased to 44,000, which is good news. The one thing I would say to you is that it's probably worth about €100 to each person per month. Make sure you do something with that money. Put it towards your pension, put it towards savings. Don't just absorb it in, this kind of what we call life creep. There may be a reduction in the tax on insurance company savings. Now, again, I'm not going to dwell too much on that, but if you do tune in on the 1st of October, we're going to give you a very brief synopsis of how it may impact on you specifically. I've referred to some upcoming webinars on the 19th of September, which essentially is a week from today at 1 o'clock. My colleague David Looney is going to give some really good tips around how you can best prepare for your child's education needs, whether it's secondary, third level or beyond. And I would encourage you, any parents listening, either click on the QR code there on the screen or just go onto our website. And these are free webinars, obviously, that you can listen to either live or recorded. The next one that I'm doing personally on the 3rd of October is specifically focused around helping people to retire early. And when I say retire, that's this notion of financial independence. Whether you want to continue to work until you're 75 or beyond is up to you. Our role in Alpha Wealth is to help you understand about financially what your position is and what you can do now to make that road as smooth as possible. Just lastly, we provide a financial consultation. It's a really simple system to use on our website. You can go in and book an online or in-person meeting with David Looney or myself. Typically, I would encourage you to take advantage of this. It's giving you more specialized advice in the areas that we've touched on today. We give you independent guidance on things like mortgages, which I haven't discussed, helping you make sure you navigate the lowest cost mortgage for yourselves. I come across people all the time that ask me, how can they reduce the cost of their mortgage? And there's some really simple ways you can do that. You're not necessarily tied into a fixed rate mortgage. And a lot of people, unfortunately, may have fixed at the wrong time. And I'd like to show you how you can improve your financial position by dealing with your current bank and how to best navigate that. With regards to other areas, insurances. I haven't talked about insurances today, but we give independent advice around health insurance, mortgage protection insurance. A lot of people who took out mortgages took out expensive mortgage protection plans. And I would encourage you to look at how much are you paying. If you're paying over 25 euros a month, you're probably paying way too much. And you should contact David and myself through the booking system, and we can show you how, as part of this overall process, we can help you.